This is the story of Dick Costolo. Parts of the story appear in the book The Founder's Dilemmas. Costolo is a successful tech entrepreneur. He has founded and exited several tech startups in his career, but he is most famous for being the CEO of Twitter for 5 years, from 2010 to 2015. Now, Costolo was not a co-founder of Twitter, but he joined early and played a pivotal role in its success, which is why the actual co-founders of Twitter have publicly said that they consider Costolo as a co-founder of Twitter along with them. Costolo joined Twitter in 2010 when it had zero revenue. He then built its entire ad sales function and took its revenue from zero to $2.2 billion, all within just 5 years. Costolo was also the CEO who took Twitter public at a valuation of $18 billion. In 2015, Costolo left Twitter to become a partner at a VC fund. But let's start Costolo's story from the beginning of his career, much before he became the CEO of Twitter. Costolo started his career as a software engineer. He studied computer science at the University of Michigan, from where he graduated with a bachelor's degree in 1985. But he did not take up a programming job after college. While studying at the university, Costolo had become enamored with theater and with comedy. So although he had several programming job offers after college, he rejected all of them to move to Chicago and pursue a career as an improv comedian. At Chicago, Costolo performed improv comedy as part of the famous Second City comedy troupe, alongside Steve Carell and Tina Fey. His ambition was to make it to Saturday Night Live, but that did not happen. After trying comedy for 4 years and sustaining himself with odd side jobs, Costolo quit professional comedy and went back to software engineering to work at Andersen Consulting in 1989. Andersen Consulting was later renamed to Accenture, which today is one of the top software consulting companies in the world. Costolo worked at Accenture for 5 years and ended up managing a large software team for them before quitting in 1994. It was at Accenture that Costolo found his 4 future co-founders, Eric Lunt and Steve Olachowski, who were programmers like him, and Mark Rettig and Matt Schaub, who were user interface designers. While Costolo was at Accenture, he also learned about the internet and came to believe that it was going to be a very important technology for the future. He pitched his managers to take up more internet projects but was rejected because Accenture believed at the time that the internet was a fad that would pass. So Costolo, Eric, and Mark decided to quit Accenture and start up a software consulting startup that would specialize in building internet projects for their clients. They called their startup Burning Door. The trio decided that Mark would continue to design user interfaces and Eric would continue to focus on building software for Burning Door's customers. But Costolo would need to learn a new skill. He would have to learn how to be a salesperson and sell to new customers. As a result of this role division, the Burning Door trio landed many web projects early on. But they soon learned that it was very hard to build leverage in consulting. They had to continuously acquire new customers just to keep getting the same revenue every quarter. It was very hard to build a large revenue base without hiring a large number of people. They contrasted their situation to software product businesses, where you could build large revenues without adding more people, because you could keep adding more customers on practically the same code base. Therefore, they started looking for opportunities to build software products instead of building their software consulting business any further. One such opportunity arose when the Burning Door trio met 2 business guys from Kellogg School of Management who had recently started a company called Digital Knowledge Assets, or DKA. DKA believed that blogging was going to become big in the future and wanted to build software products for businesses to better manage their blogs. But DKA did not have the technical abilities to build such products, so they made an offer to acquire Burning Door. Now, the acquisition offer was not for cash. It was only for DKA's equity, and even that equity would be unequally split, in such a way that the Burning Door trio got little, while the Kellogg guys retained most of it. But the Kellogg guys promised that the Burning Door trio's roles at DKA after the acquisition would be equivalent to that of co-founders, and that all decisions at DKA henceforth would be made through consensus of all the 5 together. This convinced Costolo, Eric, and Mark to accept the acquisition offer and to start building software products for blogging. However, Mark did not stay long at DKA and left to pursue other opportunities. Mark's departure prompted Costolo and Eric to bring in Matt Schaub and Steve Olachowski, two of their old colleagues from Accenture, to join them at DKA. Now, although everyone had agreed to take decisions only by consensus, Costolo and Eric soon learned that consensus could only ever be achieved if they agreed to do what the Kellogg guys wanted. This was true even in areas of technology, where Costolo and Eric had vastly more experience. This taught them a bitter lesson that consensus decision making does not really work. They learned another lesson when DKA hired a VP of sales. This person came with years of experience and a Rolodex of potential customers. He quickly signed up customers for pilots of DKA's blogging product. But the features that he promised to pilot customers were futuristic, and DKA needed much more time to implement them than what he had initially led on. This caused a lot of dissatisfaction for early customers. So DKA had no option but to pause new sales for 6 months and to focus only on implementation. During this time, the VP of sales had little else to do because his skill set was highly specialized, and he became a burden on the rest of the company. From this episode, Costolo learned how important it was for early stage startups to hire jack of all trades, employees who were young and flexible and who could be retasked with entirely new jobs if the priorities of the startup changed, which they often do. DKA raised its first round of funding of $2 million from a strategic investor, which was a large company where one of the Kellogg guys had worked before. Costolo thought that raising initial funding from a strategic investor was a genius move because the strategic investor did not interfere in board meetings, which saved DKA from distraction, and also because the strategic investor had valued DKA much higher than any financial investor would, which had minimized dilution for all the co-founders. However, Costolo learned about the downside of having an early strategic investor when DKA wanted to raise their next round. The strategic investors' priorities had shifted, so they didn't want to fund DKA any further, and VCs weren't willing to fund DKA either because they were skeptical that the existing strategic investor may block them from a fair exit at a later date if DKA became a large success. This left DKA no choice but to accept a fire sale when their current funds ran out. The fire sale caused a lot of conflict between the 4 remaining co-founders because they had a severely unequal equity split between them. While the Kellogg guys wanted to sell because they were at least making some money in the deal, Costolo and Eric wanted to continue on because they weren't making anything of substance at all. So from this episode, Costolo also learned that unequal equity splits between co-founders can lead to misalignment and conflict, which can often worsen the outcome for everyone in a truly lose-lose way. After the failure of DKA in 1998, Costolo, Eric, Matt, and Steve immediately founded another startup, and this time they called it Burning Door 2. The idea was to start web consulting again, to pay their bills and to look out for opportunities to build another software product. Finding such an opportunity did not take much time. Their ex-co-founder at DKA, Mark Rettig, had thought of an idea while they were still at DKA. The idea was to come up with a method to track internal web pages of their customers and send alerts if something on a web page changed. But they hadn't pursued this idea at DKA. Now the team thought deeply about this and decided to expand the idea to the entire internet. They were going to build a tool that could track any page on the internet. A user could set an alert for any page and get notified when something on that page changed. For example, a user could track a blog and get an alert when a new entry appeared on that blog. Or the user could track the airfare on a route and get an alert whenever the airfare dropped. The team called this tool Spy on It because they thought of their web page trackers as spies. Users could use these spies to spy on web pages of interest and get an alert if something changed on such a web page. This time, the Spy on It team decided not to make decisions by consensus, having learned this hard lesson previously at DKA. Instead, they designated each founder to be an expert in one area, and the area expert then had the final say on any decision within his area of expertise. So, technology decisions belong to Eric, and user interface decisions belong to Matt. But product, operations, and business development decisions were still shared by Costolo and Steve. This sharing once again led to multiple conflicts between Costolo and Steve and took them 2 years before they could understand each other deeply enough and develop enough trust in each other to divide decision areas amongst themselves intuitively. In the Founder's Dilemmas, Costolo explains, Steve and I began sharing tasks and we had to figure out who was doing what. It was contentious at times. His role took 2 years to evolve. The one area that none of the founders wanted to run was HR. So they brought in a head of HR early on and gave him the full responsibility for recruitment. This worked well initially as the founders could focus on their business responsibilities and did not have to bother too much with interviews and assessments. But this decision started to backfire within an year because HR kept hiring people who looked great on their resumes but who were not a cultural fit with the founders or who were not able to work within the chaos of an early stage startup. Costolo and team learned from this episode that there was no shortcut to recruiting for the founders of any early stage startup. Founders must learn how to attract great people to join them in their startup journey. This is not something that HR alone can do. Another learning they had was about jack of all trades. At Spy on It, Costolo and team had exclusively hired jack of all trades based on their prior learning at DKA about the need for flexible employees. However, now they saw that the jack of all trades that they had hired were taking too much time to learn how to perform at scale. It slowed down the pace at which Spy on It moved. This taught them the value of specialists in accelerating the pace of execution at a company. Costolo and team now understood that startups needed both jack of all trades as well as specialists at different stages of the startup's journey. Spy on It gained popularity rapidly and became one of the top websites listed on Yahoo in 1999. While raising Spy on It's first round of funding, Costolo and team did not know any VCs that they could have approached, but they knew a few angel investors who got together and invested $850,000 in Spy on It. Because it was an angel round, Costolo was able to persuade everyone not to form a board for the company. Based on his learning from DKA, he thought that not having a board that could interfere would help him focus more on the business and get more done without distraction. However, this spectacularly backfired when Spy on It tried to raise their next round of funding. Because they did not have a board asking for monthly metrics and accounting statements, Spy on It did not have updated financial information readily available, which wasted a lot of their time when they had to report these numbers to potential next round investors. For the second round of funding, Costolo met many VCs multiple times and learned a very valuable lesson. Even though none of the VCs said yes to investing in Spy on It, most VCs did not say an explicit no. Initially, Costolo thought that it was a good sign if a VC did not explicitly say a no. To him, it meant that this was a maybe that could in future be converted into a yes. But later he began to understand that VCs frequently avoid saying no because saying no is contentious. Founders usually defend their point of view when they hear a no from a VC, which wastes the VC's time and can potentially spoil the relationship. Hence, it is important for a founder to learn how to hear a no from a VC's behavior, which is what Costolo learned. Spy on It could not raise its second round from VCs. Costolo felt that the one VC that came close to giving them a term sheet was DFJ Portage, which was based in Chicago like they were, and where the Spy on It team had succeeded in building a relationship. With VCs not investing in their second round, Spy on It had no option left but to court strategic investors. One such investor was a Canadian software consulting company, 724 Solutions. 724 wanted to make an investment offer for a minority stake in Spy on It, but Costolo and team told them that they wouldn't consider anything less than a 100% acquisition because they had seen at DKA how having a strategic investor made it impossible to raise money in the future from any other financial investor, and would leave the founders at the mercy of 724 for any kind of future exit. 724 made Spy on It an acquisition offer for $53 million, but all in 724's equity to be vested for founders in 3 equal tranches over 3 years. Costolo and team would have liked the deal to have more cash component and less equity, but they didn't have many options at this point, so they decided to take the deal in September 2000. Unfortunately, the dot-com bubble burst soon afterwards, and the value of 724's equity fell steeply. As a result, Costolo and team made very little money in the end. Costolo later jokingly measured the money they actually made in this $53 million deal to the number of coffees that they could buy at Starbucks. It was worth enough money to keep us knee-deep in tall skim lattes at Starbucks every morning for a year. Costolo, Eric, Steve, and Matt left 724 and founded yet another startup in 2003. This time, they called it Burning Door 3. The idea was, once again, to do web consulting to pay their bills while looking out for opportunities to build yet another software product. While Costolo and team were at 724, Netscape had released the RSS standard in 1999, which allowed blogs and other web pages to publish updates in a computer-readable format. Users could use RSS to keep track of all the web pages of interest to them, instead of manually visiting these web pages to see if something had changed. RSS was solving the same problem for the user that Spy on It had solved, but in a different way, and RSS was rapidly gaining popularity. Costolo and team had been following the adoption of RSS from its initial days. While doing consulting at Burning Door 3, Eric was thinking about the developing RSS ecosystem and realized that the content publishers who were publishing an RSS feed did not have any way of showing ads in their feed. So even if a publisher had millions of people reading its RSS feed, it had no way to monetize this engagement. So Costolo and team decided to build a tool that would help publishers manage and monetize their RSS feed. The tool would aggregate ad buyers on one side and content publishers on the other side to sell ads that would appear within RSS feeds. They decided to call this tool FeedBurner. Costolo immediately started the fundraise journey for FeedBurner, but found it very hard to get any VCs interested in an RSS tool. RSS was a new technology, and VCs did not yet believe that it could become big in the future. Costolo joked in a later interview, "Investors didn't know how to spell RSS. It was hard to raise our A round." However, DFJ Portage was interested. This was the Chicago VC with whom Costolo had built a relationship during Spy on It. Quoting Costolo, "We were in Chicago and we had spoken to several potential investors for Spy on It. Though we had sold the company, we had created relationships. So when we did go to raise for FeedBurner, it was one of the folks at DFJ Portage who had earlier considered investment in Spy on It who said, 'I may not particularly believe Dick's growth numbers, and it's very early for this, but these guys have done this before, and they have worked together for a long time, and I'm willing to bet on that.' It was more of the team and history that got us through the A round." DFJ Portage invested $1 million in FeedBurner in 2005. Immediately after raising money, Costolo formed a board and set up a system to report monthly metrics, having learned his lesson at Spy on It. Role division between the four co-founders was also quite easy this time, because they all knew each other's abilities and trusted each other implicitly in their areas of expertise. This time, Costolo and team did not outsource HR. They kept all recruitment with themselves and instead decided to outsource finance to manage the company's books of accounts well from day one. They also knew that they had to hire specialists from day one, but learned that hiring specialists early on is hard because specialists prefer the more structured environment at an established company over the more chaotic environment that is typical of an early stage startup. Their previous hiring experience also helped them create different hiring frameworks for different departments. For example, in software engineering, they knew that they had to hire only the best software engineers on an absolute scale. There was no scope for a hiring mistake in software engineering because even a single mediocre hire could really damage code quality for the product. And this would be very hard to detect until much later when the damage may be tough to reverse. On the other hand, in sales, the right framework was to hire fast and fire fast because it was tough to judge a salesperson's ability based on an interview. Even bad salespeople knew how to present themselves well in an interview. It was better to hire salespeople fast and to fire them if they were not meeting their quotas. This time, when it came time to raise a Series B round, Costolo and team knew that they did not want to be at the mercy of VCs. So they engaged with VCs as well as potential acquirers in parallel. This deterred acquirers from making lowball offers and also forced the VCs to make up their minds quickly, or else the team may just sell the startup instead of accepting any VC term sheet. This competition got them final offers from VCs as well as acquirers, and the team chose to go with VCs for Series B because they believed FeedBurner would grow to be much bigger from where they were at the time. They raised $7 million in Series B with 3 VCs participating in the round. With the Series B amount hitting their bank account, FeedBurner started aggressively acquiring more content publishers and partnered with Google and Yahoo Ads to show these ads in the RSS feeds of publishers. But they ran into a problem. Google and Yahoo Ads at the time were search ads. Search ads were relevant for users when users were searching for something, because these ads invited users to take an immediate action, like buying an item. But when users were casually looking at their list of RSS updates, they were not in a state of mind to take an immediate action. So because search ads were not relevant for casual users, users did not click search ads in their RSS feed. This meant that FeedBurner wasn't able to generate much revenue for content publishers even if they showed a ton of ads in their RSS feeds. So Costolo and team decided to forego Google and Yahoo search ads and to build their own ad network from scratch that would focus only on brand advertisements and not on search ads. Brand ads were designed not for immediate action but only to create awareness in the viewer's mind. Such ads were a better fit for users casually looking at their RSS updates. Building this ad network from scratch for brand ads was a tough ask, but Costolo and team succeeded, and it created a lot of value for the content publishers who used FeedBurner. By 2007, FeedBurner was practically the only player in its category and had onboarded a large proportion of content publishers on the internet. This had made it uniquely attractive for brand advertisers, which had then effectively created a lock-in on publishers. This network effect was hard for anyone else to break, so FeedBurner started receiving large acquisition offers from Google, Yahoo, and AOL. In June 2007, the FeedBurner team decided to sell to Google for $100 million in cash. 13 years after they started Burning Door, the four co-founders finally made real money in their amazing entrepreneurial journey. After the acquisition, while at Google, Costolo met Evan Williams, who had recently sold Blogger to Google. Evan founded Twitter after leaving Google, and when it came time to monetize Twitter's feed with brand ads, Evan pulled in Dick Costolo to take over as CEO in 2010 and build Twitter's ad sales, as he had done before for FeedBurner. Over time, the popularity of RSS waned as people started to rely on social media to get their updates for news, blogs, and other content. In a way, RSS readers were replaced by the algorithmic feed of Facebook, Twitter, and other social media companies. This was the story of Dick Costolo. Next, let's explore what we can distill and learn from Costolo's journey about the nature of entrepreneurship and about the nature of great startup ideas.
Hey there, I'm KJ Saxena, founder of Relentless VC. The video you just watched is part of the Venture Capital and Entrepreneurship specialization, which is available absolutely for free on relentless.ventures. Go check it out. If you're a tech startup founder and want to raise money from us, you should apply on our website. Lastly, if you like this video, do subscribe and share it with your friends.